Hey everyone, and welcome back to another explainer. Today, we are going to decode the fascinating, multi-layered, and honestly deeply misunderstood mechanics of exactly why stock prices go up and down. If you've ever stared at a stock chart and just wondered what invisible hand is actually pulling the strings behind the scenes, well, you are absolutely in the right place. We're going to break down the real, fundamental reasons behind market movements, and we're going to rely on in-depth research, hard financial data, and some really fascinating institutional insights to do it.
We have all been there, right? It is such a frustrating reality for so many investors. You see a company that you're invested in announce just absolutely fantastic news. Maybe they just posted record-breaking revenue, or they finally launched that highly anticipated product everyone's been talking about. So you eagerly open up your brokerage app, fully expecting to see a sea of green, only to watch the stock price sink immediately after the announcement. It feels completely counterintuitive, doesn't it? Like, why in the world would undeniably good news equal a lower valuation? Well, to figure that out, we have to look way past the snappy headlines and really understand the actual physical mechanics at play in the market.
All right, here is our game plan for today. We're going to peel back the layers of the market one by one. We'll start with the supply and demand engine, move into company-level triggers, then look at macroeconomic gravity, explore sentiment and psychology, discuss the power of institutions, and finally wrap up with our conclusion and takeaways. Let's dive in.
Section 1. The Supply and Demand Engine, the ultimate market truth.
Okay, before we can even begin to talk about earnings reports or inflation data or what the Federal Reserve is up to, we absolutely have to understand the fundamental physics of the market itself. Listen, every single stock price movement, no matter how big or small, is directly dictated by one thing and one thing only: the balance of buyers and sellers. It's really that simple. Like this brilliant quote from William J. O'Neill points out, it takes big demand to move a price up, and the largest source of that demand by far is the institutional buyer. If demand for a stock grows faster than the available supply of shares, prices are forced to rise until buyers eventually decide, you know what, that price is no longer attractive to me. It's a constant tug of war. Usually, supply and demand find a sort of equilibrium, right? A sweet spot where buyers are happy to buy and sellers are happy to sell. But when an event disrupts that balance, things change incredibly fast. If suddenly more people want to sell their shares than there are buyers willing to buy them, well, supply has exceeded demand. To convince someone to take those shares off their hands, sellers literally have to offer a discount. They drop their asking price and boom, the stock goes down.
So the absolutely crucial point I want you to take away from this is that earnings, economic news, balance sheets, they don't actually change prices directly. It's not a magic formula where good news automatically updates the price ticker. What they actually do is simply change how much human beings and algorithms desire to own or sell that specific stock. They tip the scales of supply and demand. A stock's price at any given moment is literally just a real-time negotiated settlement between people deciding exactly what a tiny piece of that company is worth at that exact fraction of a second.
Section 2. Company-level triggers, the micro-catalysts.
All right, let's zoom in a bit and look at how internal company news acts as a trigger to shift that supply and demand balance we just talked about. As you might know, publicly traded companies in the US have to publish their earnings on a quarterly basis. And Wall Street analysts basically spend all their waking hours coming up with detailed estimates on exactly how they expect these companies to perform. Now, logic would tell you that beating these earnings estimates always guarantees a price bump, and missing them results in a price drop, right? It seems pretty straightforward. But the market is so much more complex than that. Sometimes a company can absolutely crush their expectations, and the stock still plummets. Why does that happen? Because we really have to consider what investors were truly expecting deep down, completely separate from the official Wall Street estimates.
And this brings us to a really crucial concept, one that trips up a lot of people: the idea of being priced in. This concept alone explains why betting on earnings reports is actually a really high-risk game. Think about it like this. If the general public already strongly expects a company to knock it out of the park and beat those analyst estimates, investors are going to start buying up the stock well ahead of time. They're anticipating the win. All that buying drives the price up before the earnings report is even released. The good news is already priced into the stock. So if the company then comes out and reports a perfectly respectable 15% rise in earnings, but the market was secretly anticipating a massive 30% surge, well, that 15% increase is suddenly viewed as a massive disappointment. The resulting wave of selling drops the share price, even though the company technically performed really, really well. It's all about expectations versus reality.
But obviously it goes way beyond just earnings. Specific, unexpected events shock the system all the time, instantly recalibrating investor demand based on the perceived future value of a company. Take product recalls, for example. When Chipotle had its lettuce recall a while back, savvy investors realized this was a temporary hit to their image, not some fatal flaw in their core business model. But compare that to a tech company recalling glitchy hardware. That signals a much deeper, more expensive product issue, and investors react accordingly. We also see massive demand shifts from things like stock splits. Think about Apple making its shares cheaper to attract a wider pool of retail buyers. Or, on the flip side, sudden, disastrous bad news. Think major data breaches like Equifax, or massive privacy scandals like Facebook's Cambridge Analytica. Events like those send investors running for the hills, wildly reevaluating the company's risk profile in real time, and causing a massive supply of sellers that crushes the stock price.
Section 3. Macroeconomic gravity. The global forces.
Zooming way out now to our third layer, we start to see how the broader economy acts as a kind of gravitational pull on every single stock in the entire market. Look, even the absolute greatest, most profitable company in the world cannot completely escape the macroeconomy. The Federal Reserve uses interest rates, specifically the federal funds rate, exactly like the gas pedal and brakes of a car to control economic growth. It's a perfect analogy. When banks can borrow money cheaply from the Fed, they turn around and pass those low, attractive rates onto consumers for things like mortgages and auto loans. This acts as a massive gas pedal for the economy. Consumer spending rises, businesses feel confident to invest in research and development, hiring goes up, and the stock market generally booms because money is flowing freely. But when things get too hot and inflation starts creeping up, the Fed has to step in and slam on the brakes by raising those interest rates. Suddenly, borrowing becomes expensive, corporate growth slows down because capital costs more, profit margins get squeezed, and we very often see broad market corrections as a result.
The 2008 housing crash is just a brilliantly clear example of this cause and effect in action. When that crash hit the global economy, the Fed literally had to floor the gas pedal. They dropped interest rates all the way down to zero to artificially stimulate borrowing and basically save the economy from totally freezing up. And then, over the subsequent years, as the economy finally began to recover, they had to very slowly and carefully lift their foot off that pedal, gradually raising rates again to prevent hyperinflation. And speaking of inflation, market data historically shows a massive, undeniably negative correlation between inflation and stock returns. When unexpected inflation hits the economy, the market reacts incredibly harshly, pulling down stock valuations almost across the board. It changes the math for everything.
And these macroeconomic forces, things like inflation, GDP growth, and those interest rates we just discussed, they are meticulously, obsessively tracked by big institutions to forecast long-term capital market returns. The underlying financial math is that the level of interest rates directly affects how we value a company's future cash. Higher interest rates mathematically reduce the present value of future stock returns. So when institutional modelers plug a higher assumed risk-free rate into their massive complex calculations, the fundamental present value of the stock market as a whole drops. It's a deeply complex web of variables, but ultimately, it all comes right back to our first principle. How do these global forces influence the supply and demand for these assets?
Section 4. Sentiment and psychology, the hidden hands.
Okay, for our fourth layer, we have to look at the human element. Wharton research actually proves that raw numbers and fundamental data aren't the only things running the show. Human psychology plays a massive, massive role in creating stock market anomalies and mispricing. It all comes down to friction. Because it is so much harder to short sell a stock than it is to buy one, waves of positive sentiment can very easily create overpriced, bubbly anomalies. Just think about it for a second. If you are feeling optimistic about a stock, what do? You log into your brokerage app on your phone, you click buy, and you're done. It's completely frictionless. But if you are pessimistic, if you firmly believe a stock is wildly overpriced and due for a crash, betting against it requires short selling. And short selling is tough. You have to find a broker willing to lend you the shares, you have to pay borrowing fees, and you take on technically infinite risk if the stock price decides to just keep climbing anyway.
So what this ultimately means is that during a bubble or any period of really high market sentiment, the market isn't operating rationally at all. Investor sentiment literally overrides the fundamental financial data. Researchers who spend their lives looking at various market anomalies found that they are strongly linked to mispricing that is purely driven by sentiment. When market enthusiasm is riding high, the optimists basically run unchecked. The pessimists face way too many barriers and costs to short sell enough shares to correct the price. So it is simply far easier for a wave of positive sentiment to drive a stock's price up into wildly overvalued territory than it is for negative sentiment to drag it down into undervalued territory. Emotion takes the wheel.
Section 5. The power of institutions. Market efficiency.
So, we've just seen how human sentiment and emotion can completely distort prices. But prices usually don't stay distorted forever, right? So how do they get fixed? Enter the heavyweights. Let's peel back the final layer to look at institutional investors. We're talking giant mutual funds, massive pension funds, and major global banks. Academic studies consistently show that the more institutional ownership a particular stock has, the closer its actual market price tracks to its true fundamental value. So how exactly do they do this? Well, first off, they trade aggressively on highly detailed, private research to exploit any mispricing they find. Second, they trade passively. If uninformed retail investors are suddenly panic selling because of a scary headline, these institutions act as liquidity providers. They gladly step in and buy up those cheap, discounted shares, which actually dampens that temporary panic-driven price swing. Third, because they hold such massive amounts of stock in their vaults, they're the ones providing the vast supply of lendable shares that short sellers actually need to push inflated, bubbly prices back down to earth. And finally, they constantly compete with one another. This fierce competition forces new information to be priced into the stock incredibly fast.
So the crucial bottom line takeaway for this section is that institutions are the market's great balancers. They are constantly at work, pulling wild, sentiment-driven prices back to economic reality. If a stock's price deviates too far from its actual fundamental value, whether it's way too high or way too low, institutional investors are going to step in. They will either buy the dip or short the peak, leveraging their massive amounts of capital to restore efficiency and rationality to the market.
Section 6. Conclusion and takeaways.
All right, let's wrap up this explainer and summarize everything we've just uncovered about the true mechanics behind stock prices. Understanding this deep, multi-layered web is exactly what separates a novice trader who panic sells at every scary news headline from a truly informed investor who actually understands the underlying physics of the market. We've seen that stock prices are, at their absolute core, just a real-time reflection of supply and demand. We've learned that company-specific triggers and the massive macroeconomic gravity of things like interest rates are what actually dictate that demand. We discovered how unchecked human investors' sentiment creates those temporary, often crazy periods of mispricing, and finally, we saw how massive institutional trading acts as the great balancer, forcing those stray prices back to efficiency. Listen, if you found this deep dive into the market's hidden layers helpful and you want to keep expanding your financial knowledge with us, please be sure to like this explainer, subscribe to the channel, and leave a comment down below to let us know your thoughts. Do you agree with the Wharton research on sentiment? Let's discuss it in the comments. Your engagement genuinely helps us bring more of this kind of content directly to you.
The market is undeniably complex, but it is not magic. It is a massive, fascinating, psychological, and mathematical balancing act. So, the next time you see a stock make a wild, completely unexpected move, I want you to stop, take a breath, and ask yourself, is this move actually driven by a real, structural shift in fundamental data? Or am I just looking at a temporary wave of human market sentiment that is just waiting to be corrected? Thank you so much for joining me on this journey through the market today, and I will see you in the next explainer.